Hello, everyone, and welcome to the latest in our series of Novia Global Pulse webinars for advisors. I'm Rob Montague. I'm one of the team of international sales managers at Novia Global, and today we're delighted to welcome back Nathan Sweeney. Nathan's the Chief Investment Officer of Multi-Asset Solutions at Marlborough. And I guess today we sit about 6 months into Donald Trump's second term as US president. And I wouldn't be at all surprised to hear that during that 6 month period, commentators, advisors, and clients have used the word chaos more times than ever before in their investment discussions. We've had tariffs, we've had the shake-up of global trade relationships. We've had markets having their largest one-day falls for years. We've had market recoveries, market highs. We've had stocks obtaining $4 trillion valuations, larger than some economies. So it's a very interesting and perhaps chaotic time. So today, Nathan has got no small task of looking for patterns amid the chaos. He's going to give us his latest insights and hopefully help you to make those investment decisions going forward. As usual, if you have any questions you'd like to pose to us or Nathan, please use the Q&A button on your screens. We'll collate those and try and answer those for you at the end of the presentation. So Nathan, over to you for the chaos.
The usual, just trying to find the unmute button. So, Rob, thank you very much for the introduction. As you said, no mean feat. There is so much happening in markets today, so I'm going to get straight into it. So firstly, what I want to do is I want to give a quick recap of where we are today. So how have markets performed over the course of last year? How are they performing year to date? And importantly, what have they done over the last quarter? So I think coming into this year, everybody was talking about US exceptionalism. So the fact that the US equity market had been performing so well and that the economy was so strong and, that it was just this exceptional market and likely to continue forevermore. But clearly that's been questioned this year. So a very lackluster start to the US, which is unique really because it does tend to lead. But I suppose the interesting thing is that we saw other markets taking up that baton. So the real standout here year to date is European equity. So European equity is really getting a boost from increased defense spending by European countries. So Germany specifically coming out and increasing the amount of money they intend to spend on defense. And I'll come back to that point on intend to spend on defense. But it really does show you kind of the power of diversification because clearly, if you do have all of your assets in one region, and there will be points where sometimes that doesn't work. So, that is the real benefit of diversification. I think government bonds, are kind of eking out some positive returns, but really not the returns that we would have expected. We were all hoping to see more interest rate cuts coming through, but Liberation Day really put the brakes on those interest rate cuts coming through quicker than we would have hoped. There's been a bit of tempered expectation on rate cuts, but the real standout here is gold. So with the policy uncertainty that's been thrown into the mix in the US, it's causing investors to seek safety. So gold really standing out both last year and continuing this year. But that's not what I'm here to talk about. So today, I do really want to delve into what was driving markets over the last quarter and what to expect in Q3. So are there patterns amid the chaos? Because as Rob talked about, there was there's so much going on in markets today, but are there any patterns amid that? And then I want to kind of really take a view on what we expect to happen for the remainder of 2025 and really what does that mean for our positioning? So how do we interpret all of that? So, the patterns amid the chaos. If I think about what we had this year, we've had a lot of chaotic episodes in markets, and a lot of that has been orchestrated by Donald Trump. And so what we did here is this is one of the charts of the week we did, and we just talked about the 7 stages that Trump goes through when he's negotiating. And so you'll start to actually see a familiar pattern. Even though it might seem chaotic, there is method to the madness. And usually it starts with something extremely outlandish. So asking for the world, hey, can we buy Greenland? There's something just as totally left field and totally unrealistic. But usually there is a game plan in place and a goal in place. And in this particular circumstance, one of the real issues for the US is that it does not have security within rare earth minerals. So they don't have rare earth minerals deposits, and rare earth minerals are used in lots of sophisticated systems and microchips and defense missiles, etc. And China has a stronghold on rare earth minerals. So that's really the target there. And what you did see was a deal between Ukraine and Russia on extracting certain minerals from Ukraine, and some of those rare earth minerals are involved in that deal too. So there's method to the madness. So creating chaos, Liberation Day tariffs, to remember the board that was you came out with, and these outlandish numbers, it created chaos and confusion in markets. But again, that's a purposeful tactic because if you create chaos, it normally forces the other party to the negotiation table. So, can you imagine if you are a government in Europe at this moment in time, you've got all of your businesses in your economy saying, hey, we need to get clarity on what these tariffs are because it's really hampering our business. We don't know if we're coming or if we're going. So, we need to get this resolved. So, there's a lot of pressure on governments because of that chaos that's being created. Then there's also a tendency to make it personal. So Jerome Powell, who's the head of the Fed, this is a great example. He's calling Jerome Powell too late Powell. He's been too late to cut interest rates. So making it personal to try and provoke a reaction and get a result. Threatening to walk. If the tariffs aren't done by X date, it's not going to happen. We'll walk away. And then also manufacturing a crisis. So you can see this at the border between Mexico and the US. There's a crisis. There's people flooding in. There's fentanyl flooding in. We need to do stuff about this. So my point is there's a familiar pattern. And he'll often then declare victory even before anything has been signed. So if you look at the deal between Vietnam and the US, nothing was signed and there was victory declared. We've got this trade agreement in place, and the Vietnamese were going, I'm not sure we actually signed anything. But then moving on to the next thing and very quickly. So what's the point? So the point is when the world was first met with this approach to business tactics, ultimately it led to chaos. And we saw that in Liberation Day, where we saw a swift sell-off in equity markets. And since then, what we've seen is markets are not reacting as much. So they're starting to become familiar with this chaos and seeing the pattern among the chaos. And it was only last week that we had additional announcements on there's going to be 30% tariffs on Europe, and the market barely blinked. So I suppose you can see that the market is almost seeing what it is and then trying to decipher what that actually means. Will that actually have an impact on growth and inflation? So I think that's the first thing to comment on. The second thing, which we did get a lot of questions on, was the Middle East and the impact of conflict in the Middle East on markets. And what we did is we looked at previous instances where you've had a breakout of war in the Middle East and what that meant for equity markets. And the one thing that tends to happen consistently is you get a spike in oil prices. And generally speaking, if the price of oil, let's say the price of oil is 50, it's actually call it, let's say it's 70 because it's around that price today. So if it's about $70 a barrel and you see the price increase by about 50% from that baseline level, that tends to lead to a global recession. The reason it leads to a global recession is because you have this dramatic increase in price, which takes discretionary income out of people's pockets. I have to pay more at the petrol pump. I have less money to spend elsewhere. Therefore, I'm spending less elsewhere. The economy slows because there's less growth. Now, you do have some benefit to oil producers because they're generating more profit, but it's usually the consumer who wins out on that seesaw, basically. And what we saw when we had the US basically go in and bombing nuclear sites in Iran, we barely saw the oil price budge. And it didn't remain at a high level for a persistent period of time. So we were of the view, actually, look, It's not going to impact global growth. It's not going to have a real ramification for markets. It's a geopolitical event which markets will look past once they get past that initial shock. But then we had a follow-on question. What about the Strait of Hormuz? Is this not strategically important? 20% of all oil goes through that strait. So if the Iranians block that strait or create difficulty for ships going through there, isn't that not going to be bad for markets? And we said, okay, we'll take a look at that. So we looked at all of the oil that transit through that strait. So 20% of oil goes through that strait. We said, okay, where is that oil originating from? So you can see on the chart, it shows you that all of that oil is originating from Saudi Arabia, Iraq, UAE, Iran, Kuwait, Qatar. So it's all from the Middle East. Now, where is that oil going? Was our second question. And what we can see is that oil is going to China, the majority of it. And it's actually over 90% of all oil, which is produced by Iran, goes to China. So a lot of it is going to China. It's going to Asia. It's going to India, South Korea, Japan, and a very small amount is going to Europe and the US. So if the stated aim of blocking that strait is to disrupt Europe or the US as a response, a reaction to the bombing of Iran, then that's not going to happen. You're not going to be able to achieve your stated aim. So we said, actually, look, there's probably very little likelihood that this happens too, because it's just going to hurt themselves in a sense. So we felt that there'd be a low probability, even though the market was concerned about this. So there have been a lot of concerns about the geopolitical risks, but I think interestingly, if you look at the oil price at the beginning of this year, the oil price has been around $70 a barrel from the start of the year, and it's exactly in around that level today. So even though we've had a little bit of fluctuation throughout the year, it hasn't spiked. So therefore, we don't see a material impact on growth or a material impact on inflation or supply chains, because that was the other concern. Does it disrupt supply chains? But I want to talk about what has been one of the key things which has happened during the quarter, which a lot of people probably didn't expect. And this is dollar weakness, because this has impacted particularly a lot of international investors. So generally, you have strength in the dollar. So the US is the reserve currency of choice. So if you look at the amount of trade that is conducted in US dollars, it's about 60% of all global trade is in US dollar. So it's the reserve currency of choice. And what we've seen this year is we've seen a weakening in the dollar. So the question is, why is that happening? And the second question is, does that mean that the US is going to lose its reserve currency of choice? So firstly, why is it happening? It's happening because you have policy instability in the US. So the US has pulled back from foreign initiatives. So you have foreign aid, which the US has pulled back from. And so this has then investors questioning the US's position as a global powerhouse. Why are they pulling back from this? So are they not strong enough to support all of these measures? Are they really the powerhouse that they once were? And then demanding that NATO spends more on defense. So there's a couple of ways to think about this. So firstly, we don't think that this is the US losing its strongholds as the powerhouse or the reserve currency of choice. So what is actually happening? So from Donald Trump's perspective, he just wants to see global participants, particularly in NATO, paying their share. So, my analogy here is my father-in-law is from the US and lives in Miami. And he comes over a couple of times a year. But whenever he comes over, we go out for dinner. And whenever we go out for dinner, he pays. Now, in my mind, I almost expect him to pay because he always pays. Now, can you imagine my reaction if on an occasion he decides, actually, Nathan, let's split the bill? I'd be like, sorry, excuse me? Particularly because I've just ordered a lot of stuff that I didn't really need and went for the most expensive thing on the menu. But the point there is that that's kind of the reaction for NATO. So NATO hasn't been spending what it should have been spending, hasn't been paying its share of the bill, and now it's been asked to, and you're seeing the reaction. But now they're stepping up. So to me, this isn't the US stepping away. It's the US holding everybody else accountable. Look, guys, if there's a war on your doorstep between Russia and Ukraine, you guys going to have to fund that. If you want support from us, we need to see you paying more into NATO. You're supposed to be paying 2% and you haven't been. But the reaction in markets is questioning that. Now, on top of that, you have all of this policy instability, which is also driving that uncertainty. But when it comes to the reserve currency of choice points, if we look at global trade, as I mentioned, 60% of global trade is in dollar. The next biggest currency for trade is the euro at about 20% of global trade, and then it's the Chinese yuan, and that's just under 10%. So it's about 6%. So the question is, can Europe become that reserve currency of choice, or is it China? And the answer to that is no, not at this point, because Europe is too fractured. You have too many countries who can't make a decision. And already we're seeing this weakness in the dollar. And I haven't seen the Europeans step up to say, hey, this is an opportunity for us to seize this. Why don't we group together and create a single stock market? Why don't we group together and create strength in AI? Why don't we reduce regulation and bureaucracy? So they're not seeing the opportunity that's being presented to them, and therefore it's unlikely to happen. And the problem for China is that you don't really have trust in how the government basically conducts itself. And I give an example of one of the mums I met recently at a kids' party, and basically she was saying that she's working for a Chinese company. So it's a well-known Chinese company that basically sells stuff into the US. It's like the Amazon of China. And basically, she's saying, I can't get data from the company. The company I work for won't give me data on the company so to help me do my job. So that doesn't make sense. So that just tells you that China's not in a position to take over that mantle yet. So what's really happened is that coming into this year, because you had US exceptionalism, everybody banking, look, the US is just so strong. And when you have the US so strong, it means it's lots of growth. People are selling stuff to the US. And if you're selling stuff to the US, you're getting dollars in return. So there's demand for dollars. So the dollar is strong. And now we have all of this policy uncertainty. Trump's doing this, he's doing that. What does this mean? So people are questioning the dollar, and we've seen this people who were long the dollar taking off those trades as they kind of question that. But to our mind, look, it's not a reserve currency question at all. What Liberation Day did, as in all of those tariffs, has the potential to increase inflation, which reduces growth, which reduces company earnings, and therefore that's less demand from people for goods overseas because they've got less money because the economy is slowing. So therefore, there's less demand for dollars. So the dollar weakens. So we think it's more of a function of that. But the interesting thing is that we also believe that, look, the tariffs aren't having the impact that they were expected to have. And the reason being is because they're being pushed out. So we're not getting that big boost to inflation. We're not getting that big drag on growth. Therefore, the economy is still strong and company earnings are still strong. So this is why you're starting to see a stabilization in the dollar. So for us, obviously, you've seen this big loss, which we haven't witnessed since 1973, 86. The magnitude of it is quite severe, tends not to happen often. But we still think that, look, the dollar is the reserve currency of choice and it will reassert itself. Why? You have a deep and liquid market. You have a highly educated workforce, one of the best education systems in the world. You have lots of innovation from a company perspective, so they're way ahead on AI and tech. You have a market which is pro-business. So there's lots of reasons why they are the leader and will remain the leader into the future. But we do think that this is just one of those things that tends to happen, not that frequently, but we can see the reasons behind it. So hopefully that's just giving you some insight into kind of last quarter, what was really driving markets. So it's that pattern amid the chaos. So literally Trump's tactics, but now the market is becoming a lot more familiar with them. The Middle East, all of that geopolitics is very unsettling. However, you can see that markets kind of tend to focus on one thing, and it is the oil price and watching that oil price move, and we haven't seen that, so it's less of a concern. And then the dollar, as we've talked about, we do not think that this is the demise of the dollar. Ultimately, it's just people reassessing the policy instability which is coming out of the US. But a lot of that, there's a method behind that. It's to drive an outcome, and that's around trade. And we're working our way through that. And once we get through that, we expect to see more of a settled period. So what to expect going forward? So we think one of the biggest things that markets will be focused on is now company earnings, and company earnings are starting to come out in the US today. So over the last week or so, we're starting to see company earnings. And what this chart shows you, it shows you what companies are expecting to deliver in terms of their earnings. So this is like, have I delivered a profit or not? So companies say, look, we expect to do X, but they actually then do Y. So the actual amount they deliver. So what companies do is they try to manage expectations and then over deliver. And if you think about this quarter specifically, you should expect earnings to be better than expected. And why is that? Because coming into the quarter, we had Liberation Day. And if I'm company management, I'm thinking, okay, well, Donald Trump's just going to put tariffs on everybody across the world. So therefore, I can revise down my growth expectations because we're going to have inflation. This is going to impact consumers. There's going to be less demand for my product. There's going to be supply chain disruption. So therefore, my company profits are likely to be lower. So I'm going to I'm going to revise this number down. I'm going to reduce this number. But as I said, that really hasn't come to fruition because we didn't have the supply chain disruption. We didn't have the big boost to inflation or the big hit to growth. So there will be some sectors which have been impacted because they didn't know what to do with these tariffs. What if I'm a car manufacturer? Do I bring my manufacturing back? Don't I? The tariffs keep changing. So for those companies, there might be some slower growth as they try to navigate the landscape. But for other companies, there's been a real benefit. If you're tech companies, your earnings are generated overseas. The currency is just weakened by 10%. That's a 10% boost to your profits, basically. So, there'll definitely be winners through this. But I think the key point here is, look, you have to focus on company earnings. Those company earnings are likely to be better than expected. And we think the margins, the margin of profit that those companies are making is likely to remain high because they're now using new technology like AI to drive further profitability. Actually, I probably don't need this resource anymore because I have a computer that can do that for me. So that's what's basically happening across the landscape for companies at the moment. But then you might ask, well, Nathan, look, what about these tariffs? They're still coming through, and they're likely to have an impact, and that can impact growth and company earnings. So I thought this was quite interesting. So we subscribe to research from a company called Absolute Strategy Research. And they looked at basically the imports and exports going from China to the US and from other countries like Vietnam and Thailand. So it was interesting that in May you saw a massive drop in exports going from China to the US. It was a 43% drop from the previous year. Big, big number. But the very interesting piece is that you then saw an almost equivalent amount of trade coming from Vietnam. So trade from Vietnam to the US jumping by 42%. So all that shows you is that exporters are just saying, okay, well, we won't send it direct from China, we'll send it to Vietnam, then to the US. So they're just rerouting trade. And with the trade deal that Vietnam has with the US, it says, okay, 20% tariff on all trade going from Vietnam to the US. So 20% tax on all goods going into the US from Vietnam. 40% if those goods transit through Vietnam. So if it's coming from a different country, i.e. China. But you have to remember that, and the report that we read from ASR also highlighted that in 2023, there was 150 billion of goods which went to the US, which were mislabeled. So labeling it incorrectly so that you can underestimate the value of it so that you're paying less tax. So therefore, kind of removing the impact of that tariff. So instead of it being cars, you're labeling it as microwaves, whatever it is. So mislabeled, under invoiced. So instead of it, if it's worth 2,000, you're putting it down as 200 and rerouting it, through a different country. And even if you have that tariff on Vietnam, if stuff is rerouted, just send it through another country, through Cambodia and then to the US. So there's ways and means. And if we look at Chinese exporters, they've already been doing this for the last couple of years. Because when the US administration, Trump administration, first initiated tariffs back in 2018, the exporters kind of got very wide as to what they needed to do. So I suppose the point there is that even though we'll have tariffs at a higher level, a lot of countries will be looking for a workaround to try and reduce or offset the implication on their profits. And therefore, we don't think it'll have the impact that people expect on growth, inflation, and supply chains. because ultimately companies will find a way around it. So the last thing I'd like to talk about is kind of central bank meetings, and there's been a lot of pressure on the Fed to cut rates. So Donald Trump's been calling Jerome Powell too late, Powell. You're not cutting rates. He's saying inflation is just under 3%, rates are 5%. They don't need to be 5%, cut them. And this just shows you the pattern of members, and this is for the MPC. So this is the Bank of England's voting committee, basically. And what you can see is that, the change in tone over time. So back in 2021, all of the members of that bank were holding interest rates. Then suddenly we had this spurt of inflation towards the back end of 2021, kind of midway through back end of 2021. And then we have everybody is raising interest rates. So they're raising them, by 25 basis points or more. And then you can see that slowly slowed down, and then they're beginning to hold interest rates again. And then you're starting to see interest rates getting cut. So the point there is that you can see the direction of travel here. We're now into rate cutting mode. And what really put a pause on that was we had these tariffs. Will they create inflation? Question. So the central bank is kind of waiting to see if that's going to happen or not before they continue with the rate cuts. But I suppose the point is, look, we're going to continue to get rate cuts because inflation has come down quite a bit and it's stayed lower. We don't expect to see a material impact on inflation as a result of all these tariffs. And you'll see both the Fed, which is the US central bank, and the Bank of England cutting rates, and European rates have already come down quite a bit. So that's something which we expect to see more of in the coming quarter. In the US, I think it's September is the most likely date for rate cuts. Okay. So hopefully that's just giving you a bit of insight into markets, what's happened, what to expect. Now, what does all that mean? So if we think about what's happening today, you can see, look, inflation is easing, really, and the economy is holding up much better than expected. We've seen this dollar weakness, but we still see, look, the US dollar still has that safe haven appeal. It's still the global reserve currency of choice. And when you had that, those Middle East strikes happening on those nuclear facilities, you actually saw the dollar strengthen that week. So we still believe, look, it still serves that purpose. We're seeing like basically markets are just climbing this wall of worry. So much bad news out there, but the market's just kind of basically ignoring it because they're saying, look, actually, I'm not seeing the inflation impact, growth impact. I can see tariffs are being pushed out. I'm not really that concerned about the US's stronghold because company earnings are coming through. So from a positioning perspective, you're seeing kind of a mix of value and growth doing well. Q1 was all about value. Q2 was all about growth. So that kind of balanced positioning between the two makes sense. Government bonds, look, you're getting paid a lot for government bonds now because they've sold off so much because of this concern about inflation that hasn't come through. Concern about debt, which we don't think is a concern too, and can talk about that. But ultimately, it just means that, look, rate cuts coming through, good for government bonds, and anything which is sensitive to interest rates will get a boost from interest rates coming down, like infrastructure. So I think overall that means that, look, asset class level bonds are attractive. Equity is less attractive from a valuation perspective because they've done so well over a very short period of time. But look, we still like equities. And then in alternatives, some areas look good. Gold would be a good example. Infrastructure would be another good example. I'll just talk about one area that we like at the moment. It's actually UK equity. Everybody hates UK equities. But look, they're very, very cheap. They give you exposure to lots of energy, and companies that do well in times of heightened risk. And with all the geopolitical instability you have, if you have UK equity, you get more exposure to oil, so you get a boost there. So, and actually, when you saw that first slide I showed with performance, UK equity is actually delivering good performance so far this year. So Europe first, UK second. We always put this slide together. So to give you a quick run through our central case, what do we think is the most likely thing to happen? What if economy is better than expected or worse than expected? Central case, 65% likelihood is that we get a gradual slowdown in growth, inflation falling to target, gradual reduction in interest rates. By and large, that's happening. We've had this little pause in the rate cuts because of Liberation Day, but we think that, look, we get past that and we get back on track. Good for equities, good for bonds, bad for cash. And let's get straight to what if things are worse than expected. So we had a 35% likelihood of this post-Liberation Day. We updated it straight away. And then because we've seen those tariffs have been pushed out, we've reduced that risk of recession back to 20%. So in that environment, you get a material slowdown in growth. Growth really falls hard. Inflation goes to the floor because people stop spending. Interest rates get cut dramatically. So really quick intervention by central banks. You will argue, look, that's going to be bad for equities because they'll react to the slow growth, which means recession, bad for company profits. But I would say you're likely to get that quick V-shaped recovery because central banks will intervene really quickly, drop rates, and then that just means profitability returns for those companies with lower borrowing costs coming through. So that's always the one to avoid trying to time when you get that swift fall because you're likely to get swift reaction from support, which then leads to kind of a pickup in markets, which we know in today's world of fast switch markets, they can move quite quickly. So I'll just give you a couple of final slides before we kind of move on to questions. Just a reminder who the team are. We have a very, very strong team at Marlborough. We've spent the last couple of years building it out, but we've got people with investment bank, basically experience. So, Credit Suisse, Fidelity, Barclays, AXA Group. And then we've got a good mix of youth and experience because we do believe the younger generation is very much more dialed into the data-led society that we live in. They know a lot more of the practical tools for implementing that. So, process is becoming more data and data heavy. But we also have people with different backgrounds. So, as an example, Georgina has a degree in psychology, so very different. And if we look at James, it's politics, and Andrew's geography. So, different people thinking differently, helping you to come to better outcomes. So, just a quick recap on the funds. As many of you will know, we've got adventurous, balanced, cautious, and defensive, and just giving you that tiered risk structure, which you would expect from a suite of funds, but just offering your clients some choice. And this is just a breakdown. I think the one thing which is probably different to us compared to some of our peers is, we do have that global centric portfolio. And what I mean by that is we've got a higher allocation to US equity. A lot of people, particularly UK multi-asset providers, tend to have a UK equity bias. We don't have that. We just think there's great opportunities globally, and therefore that's how our portfolios are positioned. And lastly, but by no means least, performance. So I would say, this year it's definitely been more challenging than last year from a performance perspective. The one thing which has hurt is currency has definitely impacted returns, particularly for, sterling-based investors. So if you're not hedging that currency risk, it's had an impact. But we've seen poor performance in Q1 generally for most people, and then post Liberation Day, a pickup in markets. We've seen that come through, and then markets continuing to move higher. And I think that's really down to the fact that growth is remaining robust and earnings are coming through. So I think overall we're happy with the long-term performance we've delivered. But I'm going to pause there because I do tend to cover quite a lot in a very short period of time, and I'm happy to take any questions that you might have.
Thank you very much, Nathan. Yeah, we have got a few questions come through actually. Firstly, could I ask you that we seem to be in a position where the EU are perhaps sort of waking up to the fact that they can't depend on the US, particularly in relation to technology. Realistically, is it anything the EU can do something about, or is US tech just too big that we can't catch up?
Yeah, I think the EU needs to get its skates on, and ultimately, I think if you look at the benchmark within Europe and the UK, there's very little tech exposure in the benchmark, and that's a byproduct of the fact that it's very difficult for tech companies to do business here because of regulation. So if I'm a tech company, I just think, look, the route to market is just a lot easier in the US for me. So therefore, why would I burden myself with trying to, establish a sector within Europe when it's just cumbersome? So I think ultimately, I don't think it's too late, but I think Europe needs to get a bit more savvy on regulation and trying to bring business to Europe and the UK. And I do think that what's happening within the US at the moment is it's almost a wake-up call to Europe. And you can see that they're starting to say the right thing, but that's the problem with Europe with a lot of politicians. It's the delivery on that, which is more important. But what was really surprising for Germany, particularly because they're very sensitive to inflation. They had hyperinflation, back in the 60s, 70s. And ultimately, what they have done now is they have unleashed a wave of spending on defense, which we didn't think was possible. So this is something which is new. And there is a lot more talk about trying to become a bit more tech savvy. So some of the initiatives coming out of the US, people are trying to adopt. Do we have something similar to a Doge? Do we look at how we're spending money? Do we tee up more with universities to like spend more on AI? So you did see a deal with the UK government and OpenAI. So I think they realize actually we need to get involved in this because it's firmly the US in the lead, with China pretty close on their heels, if not ahead in some areas, and everybody else hasn't even started.
Yeah. Okay. Thank you. Thank you. Yeah, a couple more that have come through. Um, do you think we're entering a period where some conventional portfolio truths like diversification benefits from bonds or gold as an inflation hedge might stop holding up?
Yeah, I think that's a very good question because I think there's a lot of new product coming out. So cryptocurrency would be a great example. And ultimately, cryptocurrency is digital gold. So it's just a new means of exchange of money, really. And if you look at the way that it acts, it's like an emerging market currency because it's so volatile. And obviously, because there's a finite supply and there's plenty of demand, that leads to the big movement in price. But there are also a lot of coins out there that are unrelated and ultimately highly speculative and can basically not worth investing in fundamentally. So I do think there's challenge to the traditional portfolio. However, having said that, a lot of people are concerned about US debt, and we don't think US debt is an issue today because the economy is growing. And because the economy is growing, it means they can service their debt. I think they're fundamentally aware that they do need to tackle spending, but what they want to do is have growth initiatives to drive that growth. And the US is in a position to do that. So I do think that if we did have a wave of volatility, you would get government bonds acting as they should because you have that high level of interest payment there today. But I do think there's lots of other investments out there to consider. Now we have more things like kind of private markets and infrastructure and commodities. So I think for multi-asset allocators, the products have always evolved over time. So I've been managing multi-asset portfolios now for 20 years. But when I first started out, they were very different. There was white labeled funds, and they've kind of morphed, and the products which we use in them has changed, and the instruments we've used. So getting factor exposure to ETFs is new, etc. So I just think that continues, that kind of I suppose transition of those products over time will continue, and you'll see different asset classes coming in.
Okay, excellent. I think we've probably got time for one more. I think you've touched upon it with the breadth of the team, but how do you distinguish between geopolitical events that should prompt real portfolio adjustments versus those that markets tend to digest quickly?
Yes, and I think that's the key. So I think for the Middle East, I've kind of gone through that in detail. If we saw basically oil supply disruption in the Middle East, then that would be a cause of concern. So if there was significant oil supply taken off stream, then that would likely create an event in markets, as in a global slowdown. So that would be the thing to watch out for there. I suppose when it comes to markets generally and geopolitics, there's a lot of it, and a lot of it, really from a portfolio perspective, doesn't necessarily have an impact. So what we're really looking for is what is the impact on business as a result of the geopolitics. So is it a conflict which is disrupting, supply to some specific industry, which will then have a knock-on effect to an economy? So that's the way of considering it. And then also the size. So if you have geopolitics in a region, which market does it hit and how big is that market on a global scale? So the Middle East as a representative of global markets is quite small, so it tends to have less of an impact. If you had something and it, damages a much bigger region, so Europe and disrupts Europe or disrupts the US, then we've got a bigger issue. So then at that point in time, we'd be looking to see what's the impact and what do we need to do.
Okay, excellent. Nathan, as always, thank you ever so much for your insights today. I'd urge any of you that don't already follow Nathan's chart of the week via the Marlborough website or your usual connections to seek that out. Some fantastic, highly topical information for your client conversations. I think you were talking about the allotment recently, weren't you,
Yes, yeah,
Nathan?
yeah, yeah.
Yeah, that's fantastic work there. Really appreciate you joining us today as well. Um, to everyone who's attended, thank you ever so much for your time. You will get sent a copy of the presentation, and it will be made available on the website shortly as well. Next webinar date for your diary is the 2nd of September, time off for the holidays. So for those of you with children, I presume a different type of chaos may be ensuing in the coming weeks. Hope you have fantastic times with families. And yes, once again, thank you to everyone. And thanks to you, Nathan.
Thank you, Rob. It's been great to be on today.
Okay, goodbye for now.